Hi, everybody, and my name is Anshuman Jhunjhunwala, and we'll be talking about chart patterns today. And this is basically a brief introduction and is only geared towards absolute beginners to chart patterns. And the idea today is to give you a brief idea about how chart patterns come about, what is how they can be used, what is the underlying phenomena that happens before you can get down to actually building specific tactical trading strategies with it. Okay, so just a little bit about myself. I'm Anshuman Jhunjhunwala. I'm an engineer, and I've passed all the three levels of the CMT examination USA. I have about 10 years of experience in the field of financial markets. I've been trading commodities, forex, and derivatives market. I'm also the founder of Fintalytics Finance and Technology LLP, and I do advise clients and help them manage their portfolio via brokerage firm, which is Untitled Capital. I'm not going to dwell too much on this. We will straight away get started with the actual gist. So let's move on. So what exactly are chart patterns, and what do we mean when we say the word chart pattern with regards to trading? So the earliest example of chart patterns was in the early 20th century, and this was basically from USA. So the earliest example of this was in 1920s. There was a person by the name of Richard Schumacher who actually pioneered this particular field of analysis. So Richard Schumacher is broadly regarded as the father of modern technical analysis. And what was happening basically was he was taking closing prices and then plotting them along for each and every date. So for example, let's say when we talk about closing prices, you have a price on day one, you have a dot here, you have a dot here, you have few dots, you connect them and you will start getting a chart. That is essentially what happened. And what we have right now is an example, which is a computer generated. So in the early 20th century, this was all handwritten. Now it's all generated by the computer. You don't have to do anything. So the basic thing that is happening here is you're taking the closing prices, you're plotting it for each of the days. So day one, day two, day three, you're just plotting the closing prices. The closing price is on the y-axis. This is where the prices are, and on the x-axis is which your date. Right. So this is an example again. This is the closing price being plotted. The price on the y-axis, and on the x-axis you have the dates. Now let's. So the question really is, what kind of information or what kind of insights can you actually draw by looking at a line chart? So let's understand a little bit about the markets and what exactly these chart patterns represent. So when we talk about the markets comprises of different types of investors and traders who have different motivation. So for example, when I talk about motivation, I'm talking about you have a fund manager, let's say, who is investing money for his clients and he has a very long-term view. You have a retail trader on the other hand who's probably trading for very short-term gains. So you have people who are coming together with very different motivations and are coming in the market and are actually expressing their views about what they think the market is going to do. Now, all these people who are coming in the market have their own greed, fear, they have their own set of emotions. So what happens is the chart actually captures this, or the sum total of all the market participants and what they are essentially looking at doing. So when we talk about psychology, we also have a term which is basically called mass psychology. Just like you have an individual trader who has his own specific likes and dislikes and who has his own psychological traits, the market also has its own own psychology, which is basically a sum total of all these market participants put together, and that is a mass psychology. Now, what the charts are doing is charts are basically representing in those charts, those shapes are representing what the psychology, the total psychology of all the participants put together. So when I say that, what do I really mean by it? Let's look at this particular chart. When we're looking at this is a very simple price chart, and what we're looking at is the most basic example of how the price would move. I've simplified this here so that it is, if you actually look at the real price chart, there will be a lot more distortions than what we have over here. Now, in this particular price chart, what we're noticing here is we have a period when the market is going up, and what is happening out here is, why would you have the prices going up from point A to, let's say, point B? It can only happen if the guy who buys here and another guy who buys here, they both think the price will continue to go higher. And when a lot of people think that, they will keep buying and keep driving the prices higher. It's not like the prices are, it's not like there's a formula, fixed formula that you punch in and you get the price output, and that is the price at which it is being traded. That is not what is happening in the market. In the market, if you're buying, somebody has to sell. And if somebody is buying and you have to, you only buy because you think, hey, I'm going to make some more money. And then what happens is the person buying at this point, and at this point, they're all thinking that the market is going to go higher. And that is essentially how this market is moving up. So if you're looking at this point here, you have a very clear idea, just by visual examination, that the market is in what is called an uptrend. So when I go back to the previous slide and I talk about the form, that the psychology, that whatever action that each of the market participants are actually performing, it creates specific forms on the patterns. So what do we mean? I'm going to talk about, so this is a good time to actually introduce what we call, patterns and the two class of patterns. And they're basically called reversal patterns and continuation patterns. So when we talk about chart patterns, we talk about some specific shapes that are being formed on the chart paper, which basically do two things. One is, let's say the prices are going higher, the reversal pattern will change the trend and make the prices move lower. The second one is the continuation pattern. In a continuation pattern, if the prices have been moving higher prior to the pattern, then what will happen with the continuation pattern is the price will continue in the same direction as to the previous one. Okay, so let me represent this over here in this particular image. So if you see over here in this slide, what I try to do is I try to explain the trending market, the continuation pattern, the reversal pattern. All right, so let's understand a little bit about this. Let's say when we have the price, like I was talking here, we had somebody who was, buying at, let's say, at this point. Okay, the prices are moving higher. There's another person who buys at this point. The prices are moving higher. Another person who's buying at this point. And basically, they're all reinforcing their belief. The result is the prices continue to move upward. Keep in mind that the prices can only go higher if somebody is willing to pay more for the stock. And the demand for the stock is much higher than the supply. And essentially, that is what the price is, and that is what the chart is telling you. It's going to tell you if the demand for this particular stock is high enough to make it go higher for a period of time. Now, let's say the person who bought here, he comes at about around this point. He says, you know what, I will sell. I'll get out of my position, and that's it. He does that. Now, a lot of people at this point who would have bought, let's say, here, and here, are now starting to sell. Of course, this is not enough to make the prices fall a lot. It only falls a little bit. Then again, the same thing happens. Some buyers are coming here. There's a small, set of buyers who drive it higher. But overall, what is happening out here is that you have a small pattern that is formed. And what exactly is this pattern that we're talking about? This is it has all the patterns have a name. I don't want to confuse you, but I'll just this is called a small continuation. It's a rectangle pattern. We will talk about the specific patterns in a little more detail ahead. But just to give you an idea, if you look at the market, you can make out that here the participants are very bullish. They continue to buy higher. But here they are shying away. They're not buying when the prices are going higher. They're thinking about it. That should I buy it here? Should I buy it here? And once that happens, you basically get what is called a consolidation pattern. So here I have again marked out. So when you have a continuation pattern, you have a market which is trending. So you have a market which is trending here. In a continuation pattern, the market consolidates. Okay. But once a continuation pattern is formed, that let's say a lot of people who had bought here, they're not enough sellers. And then over a period of time, let's say something happens, there's a news or there's an expectation among the participants that, you know what, I think the stock is really good, or maybe people are anticipating good results. Maybe people think the environment has changed. Let's take the example of pharma stocks at the moment, maybe. Suddenly because of the current situation, the pharma stocks are doing well. So it's possible that they will form this pattern, and then a large number of participants say, you know what, I think the stock is going to make higher highs, and they are then willing to pay much higher prices. Once they start doing that, you get what is higher highs, and you get a breakout. It's called a breakout. Again, it's a technical term, but a breakout very simply means that if this was my high and the prices have gone above it, then I have a breakout. Now, this in a continuation pattern, what we are seeing is we have the prices coming in and exiting, and they have pretty much the same direction. So over here, the entire duration, the prices have continued to move in only one direction, that is upward. Now let's come to the reversal pattern. So when I talk about a reversal pattern, you will notice a reversal pattern is much larger in shape than what we have the continuation pattern. And what the reversal pattern will do is, if the prices are moving higher, it will now change the trend. So let's say again, going back, let's say the automobile stocks, before the pandemic, they would have been moving higher. And now you have a reversal pattern, which was, let's say, during the pandemic, and the trend would have changed. All of this takes time. When we talk about market participants, the prices are not going to move unless and until somebody is buying and somebody is selling. So essentially, you need to have some, whatever it is, whether it's continuation or whether it's a reversal.
Achha, no worry. Yeah. No worry.
It's going to take some time. So when we talk about any reversal, it's going to take some particular amount of time. Now let me just clear all the drawings. And so let's talk about in detail about what I've just discussed. You have a scenario where the market participants are not sure about the future course of events for a stock. And what you see is a reduced activity. When I say reduced activity, this is what we talk about in a continuation pattern. Both the buyers and the sellers are not sure what to do. So what is happening is, you have buyers and sellers. The sellers are not really going out and selling their holdings, saying, you know what, there's something really wrong with this stock. They are not doing that. At the same time, even the buyers are not going out and buying at higher prices. So essentially what happens is you get a consolidation. Also, what is going to happen is a large number of other participants, they are going to see this stock and say, nothing is happening in this stock. And so there are no additional fresh participants who are coming into this stock. And the result of that is that the volumes will continue to fall. Let's talk about real life examples. So I've plotted the Adani, this is Adani Port chart. This is on monthly time frame. Now, this chart is, it's following some of the most basic principles of chart analysis. You have trends, and then if I just want to draw, you have two horizontal lines here. And these lines are basically telling you that there was some consolidation. And just look at how long this consolidation has taken place, right? You have a consolidation, which is this one, almost from 2011 to end of 2014. So you had a stock which was basically doing nothing from 2011 to end of 2014. But when it did finally break out, now what is happening over here when you say that you have a breakout? Anybody who was buying the stock here, whoever has bought at this point, most of them are in profits. Now, a lot of people who are, let's say, holding the stock and they now see the higher prices, they will be like, most of the times, the general public would be relatively calmer when they see higher prices. They are not really panicking. So whatever people who are holding the shares, they're not really going to go out and sell that stock much. So you don't have too much supply. At the same time, what it shows is that there are new buyers. You are essentially getting new buyers in this stock, and those buyers are willing to pay higher prices for this particular stock. And the result is you get higher levels for that. Now, the interesting thing is, at the end of 2014, the price of this stock was roughly about 170. It goes up all the way to 180, and that happens. Though the consolidation was almost 4 years long, the movement or 100% return happened in about a year's time. And that is a very important thing that we all should note. And this is something I'll also talk about in one of my slides later, is that market, is like you have a market which is expanding and contracting. That is essentially how the market moves. There's a series of expansion and a series of contraction that take place in the market. And when I talk about expansion and contraction, I'm talking about exactly this. You have periods where there's contraction, where not much activity is happening. It continues to contract. The range in which the prices are moving, they contract. And then at some point, you will get, markets cannot continue like this forever. You will get an expansion. And when that expansion happens, it's generally quite fast. And the longer this contraction happens, the faster is that expansion. Just like what we saw here, we had almost 4 years of not, imagine if somebody has bought it here. For 4 years is sitting on this stock, he has got absolutely no returns. He has just seen the stock go from 84, 160, of course, big range because it's a monthly chart, but essentially he hasn't really gone anywhere. If you bought here, the prices are right there. So basically what is the market doing? It's nothing. It's a period of contraction where the prices are contracting compared to what you were seeing earlier. And then after this period of contraction, you get another period of expansion. And in that expansion, the prices jump up by more than 100% in less than a year. In about 25% of the time of the total contraction that took place, you have 100% return in the stock. Now, this is classical of how the markets behave, and it is not just stocks. It's something that is observed across all asset classes. Though in this particular webinar, we are going to talk only about stocks, but this phenomena repeats itself across stocks, across commodities. It will repeat itself across, even forex markets and even different time frames. Right now, we're looking at the monthly. The same thing will happen on the daily. Same thing will happen on the hourly chart. So in essence, this is like what the chart patterns are doing is they are mapping out the basic psychological makeup of the market participant, and that is universal. So when anybody is going and trading in the markets, no matter, even after 10 years of experience, I still undergo cycles of greed and fear. After a couple of days when I do really well, I feel invincible. And then after a day when I do bad, I start feeling, not so good about what I've done. Even after a decade of trading, there's still that sense of disappointment if I haven't done well. So what happens is this greed and fear and this mental makeup drives the market, because they're not just one participant, there are millions of people who are trading the market. And when you map that out across different asset classes, what you realize is that this is actually something almost universal in nature. And this is the basic foundation of technical analysis or chart patterns, and that is history repeats itself. Now let's look at some more examples. On this very chart itself, I'm going to plot a couple of additional contraction periods which are smaller in size, and I'm going to tell you how they look like. So if you can, I would like to just, now this is another contraction period. What is happening? The prices are not doing much. They are just in a sideways range. And then this entire pattern is broken down here, and look at how fast the prices have fallen. So this is a monthly candle. So here, this one is 1 month. So in about 4 months, it has given up 50% of its gains. All right. Now, what I'm going to do is we are going to go to the next chart where these are bar charts. I am not going to cover the bar explanation. We are going to look at the line charts. Okay. All right. Okay. Now let's look at let's look at this particular. This is Axis Bank, and this is again on the monthly time scale. So you can see here on the x-axis, we have all the days, and on the y-axis, we have the prices. Now, something very similar is happening even here. There is actually very little difference. That was Adani Ports, and this is Axis Bank. It's a different stock. Adani Ports and Axis Bank are stocks which are in different sectors, and they have very different behavior, but yet the patterns that they are forming is actually quite similar. So let's just talk a little more about, let me just draw a couple of lines to give you a sense of what I'm trying to say. Okay. Now, this is a period which we call a trend period, right? So we have had the markets go from 2009 to 2011. We see a sharp rally, okay? But after that, from 2011 to almost 2014 and again, we see the markets do basically nothing. They are in what is called a sideways or a consolidation pattern. But look at what happens again. Again, once it goes above at this point, the same thing is happening. A lot of returns in very little time, okay? Now, there is another place here that we can draw a very simple contraction period. So the market that I was just representing in the previous diagram, the same thing is going to repeat again. You again have a period of contraction followed by a certain degree of expansion. Now let's go to the next chart. Okay, again, I'm going to take another stock from which is Dr. Reddy's Labs, and this is from a different sector. This is from a pharma sector, and not related to either of the two stocks that we've just discussed. But like I was saying, that the market, the behavior patterns of the market participants repeats itself across different asset classes, across different stocks. That is why technical analysis can be applied on different instruments. And now here you see the same thing. There's very little difference in what this stock is doing versus what the previous two were doing. You again have a period of trend, okay? And you again have a period where you have a large consolidation where the stock does nothing, coils about. And then again, at this point, you have a breakout. And just look at the kind of returns that you have gotten from there. You have gone straight away from about 1,000 rupees to 4,800 because, and prior to that, for almost 4 years, from 2003, in fact, more than 4 years, from 2003 to about 2009, this stock hasn't really, been that bullish. It's gone up and down. If you bought here and you sold here, maybe you could have made some money. But look at the returns that you get once you buy it, and look at the ferocity with which it goes up. And that is classic of how the markets behave. So when you have the market always does this, it will undergo a series of contraction and a series of expansion. Now, this series of contraction and expansion is fractal in nature. Okay. So when I say fractal, what does the word fractal mean? It basically means that this particular behavior of the market, it repeats itself at different levels. So you have a monthly chart where you're having, a very large, where you're having this large pattern, which is, starting again on, consolidating for, let's say, 5-6 years. But then at the same time, you have a slightly smaller time frame here, just maybe a year or so, where this contraction is taking place. Okay. And the interesting part is you have a rally, right? So this is what we're talking about. Now you have what is a continuation pattern. And then if you were to look at this, you again have the prices going higher from here. Okay. So the same behavior, the same chart pattern that we have applied for the earlier two charts are applicable even on this one. Okay. So I hope I'm clear till now. So we are going to now look at one more chart I think I have here, which I would like to show. And then we will discuss about the various patterns and how to go about deciding. Okay. Now, so in this chart, there is one thing which is slightly different. And the thing that is different here is I'm also going to discuss the volumes on this. And this is a relatively recent chart. All the charts are actually recent, but this one is right now. So if you see, most of these charts at the moment are from the current time frame itself. I've just looked at them. But granules has been very interesting because a breakout has occurred right in the beginning of this year, which was at about 110, and the stock is currently at 208. But here I want to talk about the same thing that we discussed. We have discussed, broadly speaking, we talked about how you can look at the market. You can look at market as a series of expansion and contraction. You can look at whether the market part, what is the sentiment of the market behavior when you look at the charts, when you look at the price chart. Are the market participants bullish? Are they clear, or are they undecided? Now, one of the things we discussed was that if the market participants are undecided, what is going to happen is that they are not going to be going. If you are not very convinced, you will not go out there and buy something with a lot of with a lot of aggression. So if you're not sure, you want to buy, you will buy it in relatively less amount of quantity. And when you do that, what is going to happen? You're going to see this. What these bars are the volumes. That is for each day. What is the number of shares that have been traded? Now, if you see this, this is again a series of prices are contracting, right? You have the prices going up, and then just like a string, they're contracting. The amount of movement is becoming smaller and smaller. And what is happening at that time is, if you see the volumes, they are dipping, right? Now, for any analyst, it's not just the price. When you combine the volumes along with it, it gives you a very clear sense as to what the market participants in this particular asset class or in this particular stock are doing. So why is it important to understand that? So the people who actually trade the stock, a particular stock, are actually the people who could be like, let's say, promoter family, or people who know this, who are already holding the stock, who know a lot more about the stock already. So if those people are not doing much and they're not acting, then the stock is not really going to move a lot. It's going to continue to consolidate. You cannot possibly have large price movement on low volumes. It is not feasible at all, right? You cannot have, unless somebody is willing to buy higher prices, and that person and the number of buyers, they have to be much more than number of sellers. You cannot possibly talk about having higher prices. Now, after a prolonged period of time frame, this downtick, you actually get a breakout, which is at this point over here, the market is now actually going up aggressively. And look at what is happening right there. You're looking at the volumes are now picking up. Okay. So essentially what I'm trying to say is that when you have a breakout, or when you have the market moving out of contraction, from a contraction to an expansion phase, one of the key things that can help you understand that is actually the volumes. Now, when you talk about, granules, we had, this entire phase of roughly about 2 years, right? Just less than 2 years, about 18 months. But look at how fast this stock has moved from 120 to 208. And this is just towards the end of 2020 to now, despite all the issues, despite the pandemic, despite all of that, you are just getting a stock which, after breaking out from a pattern, has gone up and given you 100% returns. And obviously, I'm looking at the weekly chart. So the point I've been trying to make all along here is that when we talk about chart patterns, we have to use the chart patterns, that is the shapes, etc., to identify what is happening, which phase the market is currently in. And then we have to confirm that phase along with the volumes that are there. And then what we want to really do as investors is, we don't want to be putting our money in the market. Why all of this is important is, you don't want to be putting your money in the market during this. You would rather be in the stock when this is happening, right? Because that is where you're going to make money. So essentially, as investors, as traders, whatever I've spoken till now, the thing that matters the most for us is to be able to identify these zones, which are called breakout zones. Once we're able to identify that, we can say that, okay, I want to put my money in this because this particular stock has a very good potential to give me returns. And I know that, I have a very clear idea as to where I can say my stop loss is. When I say stop loss, it is basically your risk that you're assuming. So essentially, as investors and as traders, the only thing that matters for us is to figure out when the stock is moving from this contraction phase into this expansion phase, and we want to align ourselves with this move. We don't want to be fighting it, remember? So for example, if you're having this, if you're just looking at this here and you're seeing the prices go down, you do not want to be buying here. You do not want to be buying here. You do not want to be buying here. Why? Look at what is happening. 2018, right? From 2018 till almost 2020, you are at the same level and you're basically, not making any money. That is why, as investors, by using chart patterns, the fundamental function they perform is they help you align yourself with the actual trend. And what they will do is, instead of wasting time here, they will put you in the right stocks so that your money, you're actually getting some returns out of it. Now, this can be done on different time frames. I've used the weekly time frames. You can do this on the daily time frames. You can do this on the hourly time frame. Okay. So, all right. Now let's talk about, I'm just summarizing here whatever we have spoken till now. And I don't want to stretch the presentation too long because we'll get too much information in too little time. So I'm sort of being repetitive to ensure that whatever little I explain, you're able to grasp it. So what we are basically seeing in the previous slides is we see prices undergoing periods of contraction and expansion. The prices are always going to behave like a coil spring. So this is a point that should all remember, that market is a bit like that, where it's like a rubber band. You stretch it and then you again compress it, you again stretch it. So in that sense, it is like, and that cycle repeats itself over and over and over again. And that is actually what gives rise to several patterns and several different shapes on the chart, which we basically utilize for identifying our entry points. Okay. And one of the most important things when we talk about the chart patterns is not the identification of the patterns actually. Whatever I've taught you in about last 10, 15, 20 minutes actually is sufficient for you to be able to identify the shapes or patterns on the chart. But the thing that will actually make you money is discipline and sticking to your stop loss. So in my experience, the only difference between a professional trader and an amateur who's just entering the market is the fact that they do not take something called stop loss. So stop loss is actually, I don't know if any of you are familiar with the term, but stop loss is exactly what it means. It is to stop your loss. And what is that? So let's go to this slide. Now in this slide, let's say you would have said that, okay, you know what, I want to buy this stock at this price. That is at about, let's say 115. But you also have to think, what is the amount of risk that I'm going to take and that I'm willing to take to enter this particular stock? And let's say you're going to put 5% of your portfolio. That is, if you have, let's say 1 crore, you're going to put in 5 lakhs in this stock. And you say on this stock for 110, I want to put my stop loss at about, let's say 20% lower. That will be 1% of your portfolio. So that is something that you have to be mindful that, yes, I am going to enter this, but there's a possibility that the chart might not work out, and I have to have a contingency plan so that I can get out. Now the question is, why do you have a contingency plan and why should you not continue holding it? In my view, it is very, very clear. If you don't have a contingency plan, you will end up in a market which is like this, So from 2016 to 2020, nothing has happened. So if you think you're okay with that and you just want to be a buy and hold investor through that, then that is fine. Yeah. But otherwise what the best thing to do is to actually look at identifying these points here where you can enter the market. Now, so a little bit about the tactical strategy that we're going to talk about. We are looking, obviously, we're going to plot the closing prices. Then we're going to look for the periods of consolidation. Okay. And when we talk about the periods of consolidation, I have just explained that those are these periods when you have a slight rectangle, when the prices don't move up in a trend, they continue to compress, the volumes start dropping. So as an investor, what you will do is you'll make a list of those charts which are showing that particular type of pattern. And then you have to wait for this expansion to begin. You do not enter it when the contraction is happening, right? You want to wait for the expansion phase to begin. Once the expansion phase begins, you want to look for an entry, you want to define your risk, and the rule that I follow is not to risk more than 0.5% of your portfolio on a single trade. So that is the strategy that I follow. Now, we're going to move on to some of the most common chart patterns that we see. And unfortunately, we're not going to be able to cover it because it's a 40-minute webinar. No matter how hard I try, I cannot possibly take you through the rules for all of this. But these are some of the most basic chart patterns that you will need to be able to trade the markets. Now remember one thing, there are a lot more things than just chart patterns. Chart patterns are one of the things, and what you can do with the chart patterns a lot of times is you can go from, let's say, monthly, go to the monthly chart, you analyze and you say this chart is an expansion phase. Then I explained to you about the fractal nature of the market. So when I say fractal nature of the market, what I'm essentially saying is you go from the monthly now, you drill down to the daily charts. And on the daily charts, you look for these phases of expansion and contraction. Because you know that on the monthly, the expansion is beginning, your likelihood of being accurate on the daily time frame is much higher. So you try and take the trades on the daily time frames now. And that is what I'm trying to say when I say the fractal nature of the markets. Because what these patterns are going to do is they're going to repeat themselves, not just on the monthly chart, but you're going to see them even on the weekly chart and the daily chart. Essentially, what I'm saying is that you have a pattern within a pattern within a pattern within a pattern, which is actually what fractals mean. So I don't know if that was a little complex, but essentially you can drill down and see these patterns at different time frames within what would be one big large pattern. Okay, now I've spoken about multiple time frame analysis. And so what happens? You got a small introduction on chart patterns. What else can you do? There are a lot of things that you can add to chart patterns themselves. And that is basically things like moving averages, relative strength index, which is more numerical in nature, where they basically will use price and volume analysis, different relationships to come up with a different set of indicators, which could perhaps improve your analysis of chart patterns themselves. So it's already been about 30 minutes, so I'm going to end the presentation here. And if you have any questions, you can just type them out and I'll see if I can try answering your questions. Okay, do we have any questions? You can just type it out and I will try answering them.
Suman, we have something from Shilpa, if you can look at the chat.
Yeah.
And so, also, guys, you can unmute yourself and feel free to ask it.
Okay, so how can you execute the stop loss? So yeah, that's a very good point. I can just answer that quickly. What I'll do is I will actually share my I'll share my screen so that you can now this is my live chart, and okay, so this is actually on the 5 minutes. So again, things don't change even on the 5 minutes, and this is actually today's chart. You see the same thing. You see the market go up, okay, and then you have the same thing again. The market is again, going, does a little bit of a correction, and then let's say it forms a small it does a small minor consolidation here. Okay, so if let's say this is can you see 393 here? Yeah. So let's say you want to buy it here at 393, and once you have entered here at 393.5, you want to place a stop loss. So there are two ways of doing it. Let's say you want to take only 2000, you have a money stop loss, which is you say I'm only going to take a stop loss of 2000 rupees. Then based on the number of shares you purchase, let's say you purchase 1000 shares and you only want to take a stop loss of 2 rupees, then you will automatically subtract 2 rupees from 393 and you will place a stop loss at 391. What is the stop loss? If let's say prices were to come down
at 391, you will exit the stop. That's basically what a stop loss is. So your broker will have a terminal where you'll be able to place these orders. They are nowadays, everything is very straightforward. You can place your orders, you can place your stop loss value, enter the order, especially if it's intraday, and they will do the execution bit for you. Now, other way of doing it is, the way I look at it is, you look at the consolidation and then you look at the previous low. So you have, this is a high, then this is a small low here, then you get a breakout. You look at the minor low that is here at this point, try and place your stops here, below the lower boundary of the pattern. Or if that is, you think that is very close by, you can put it at the slightly higher boundary if you think you want to be in the trade for a little longer. So that is how you can execute a stop loss. So how do you identify when to sell after a breakout? A very good question. So that is a point that when you talk about when to sell after a breakout, it basically is trade management. Now there are specific rules which calculate the pattern and which calculate the what we call the target from a pattern. But it's difficult for me to cover everything in this webinar, but you can do that. So essentially what it is if you have, let's say this is your pattern, you calculate the height of this. So when you say the height, what do I mean? If I were to just draw this, okay, this is the line. I'll take this line and I will put it here from the breakout, okay? And this is my target, which is 397.6. This is my first target. Now, it is not necessary that just because I have a target, every time the target is going to be met. It is very possible that the target is not met, or that the target is far exceeded, like in this case where the target has been far exceeded than what this small pattern was telling us. So that is why the idea is, the first you might want to take, let's say 50% of the profits here, but other times what you can do is you can use the concept of trailing stop loss. That's again, these are technical terms. I don't want to confuse you too much, but you can use what is called a trailing stop loss. So what is a trailing stop loss? Below every low, like for example at this point, okay, you'll put a stop loss. So when I say stop loss, what does it mean? Let's say when the prices were here, if the prices go down below this, you will exit it. So below every low, you want to put a stop loss. That is essentially what it is. Okay, so these are the points where you would want to put a stop loss. Now the interesting thing is, at this point here, your stop loss is actually taken out, which is around 417 rupees. Okay, so I hope I'm clear. These are the highs, right? These are the highs and these are lows. So the market is like moving in this, it's like a staircase, right? That is how the market is moving. You want to put your stops below these lows to ride the trend, because essentially what we want to do is we want to ride the trend. All right. Does that answer your question? Yeah, Ankit, does that answer your question? Okay. All right. So, no problem. Okay. So any more questions? Any other questions? Okay, I guess no more questions. So we're going to continue this series, and the idea is to do a series of webinars, which will be more introductory nature. If you want to do a more detailed course, you're welcome to get in touch with us, and we can do a more detailed course for you guys if you're looking at that. And you just drop an email with us, and we'll get back to you on that. But we plan to continue this series. So this is just an introductory webinar. The idea is to keep repeating it so that you all will get a sense of what is happening out here. So the idea of today's webinar was very clear, to give you a brief introduction into what chart patterns are, how the chart patterns are actually formed, and what are the underlying principles that you will use to actually trade these patterns. Okay. And a lot of points that I've said, I'm sure if you're new, this is the first time you've heard it, you will find it a little overwhelming, but trust me, it's very, very simple. Technical analysis or chart pattern analysis is actually the simplest thing you can learn. The difficulty really is in the application. You know, the learning portion is okay. Now, one more thing that you can do is go to tradingview.com. Okay. So I'll just close this. Yeah, just go to TradingView, right? You just go to tradingview.com and get your charts, and you can do paper trading here. Okay, that is amazing. So you can actually draw this and you can actually buy and sell. So you see this buy and sell here, you can actually do that. And if you were, let's say you place a buy order, you will get this. You'll get connect a paper trade account and create your account on TradingView. You also get a free account. There are paid accounts as well. So the idea is you'll be able to practice all the patterns and everything by using those by using TradingView itself. And it's, when I started off about a decade ago, these things were not there. But when you place your orders, it'll track your trades, it'll track your journals. You can go and get additional insights from it, and these are priceless things. So if you guys are having if you are really interested and you really want to apply it, I strongly encourage you to go and go to TradingView, create an account, and then try and do this. So it'll get, whatever you have learned, you will be actually able to go and observe it. And the best part about technical analysis is after 1 hour of this webinar, you can straight away go and apply it. So you can actually go to the website, create an account. You can create a free account and keep drawing those charts and keep practicing. Okay. And the another one that you can try is investing.in, which again gives out the charts for free. So just go to investing.com and create an account, and you'll get similar charts, and it is also absolutely free. And try it on different time frames, on different asset classes, and that will help you get a very good sense about how to, it basically, as the more you practice, the better you'll get at it. That is what it is all about. Okay. So I think, yeah, I think we'll end the session here, guys. I don't see any more. Yeah, okay. Thank you so much for taking time out, and it's a Friday evening, so thank you so much. So if you have any more questions, try to drop in an email, and I'll try replying to all of them. Okay, thank you so much. So happy weekend, and we'll keep you posted on the next session. Yeah, we'll keep you posted about the next session, guys. Thank you.